In Zhejiang, a factory recently shut down after the owner fled, leaving workers stranded in the deserted facility. Oh no, the boss took off. What are we going to do now? Look, the factory's been completely cleared out. This is a disaster. A similar situation happened to the Baoyi Footwear Company Limited at Yangzhou in Jiangsu. The company issued a notice stating that due to the sustained impact of the global environment and a sharp decrease in overseas orders, it cannot maintain normal operations. As a result, it decided to close its factory in China by the end of the year, terminating labor contracts with its employees. Reports suggest that Baoyi Footwear Company plans to relocate its operations to Indonesia. However, the compensation plan for the affected workers will only be available after December 31st, sparking dissatisfaction among the employees. This led to a protest where workers surrounded the factory office. Videos show thousands of employees gathered outside the factory, with hundreds occupying the office space in protest. Reportedly, Baoyi Footwear Factory in Jiangsu, Yangzhou, a Taiwanese-funded enterprise with a 17-year history in China and a workforce of between 5,000 to 6,000 employees at its peak, is known for subcontracting for well-known brands like Converse. Analysts suggest that the shift of numerous European and American orders to Southeast Asia, resulting in overcapacity, is a significant factor behind the decision of this long-standing Taiwanese-funded enterprise to pull out its investments from China. Mr. Tan, a small business owner in Guangdong, suggests that due to the deteriorating environment in mainland China, particularly the political climate, once the factory moved out, it is unlikely to return. He observes that under the current weak economic conditions in China, consumer spending is struggling. He notes a significant drop in food delivery orders and an overall economic downturn after the Mid-Autumn Festival, affecting various industries. Mr. Liu from Shandong mentions that BYD Semiconductor Company also gave early holidays, a situation that might be prevalent in other provinces as well. He touched on the widespread issues of unemployment and unpaid wages, stating that almost every enterprise owes money to the public. In the current economic climate, he reflects on the difficulty of earning money and the financial constraints faced by ordinary people. Mr. Liu recently disclosed his current employment situation. "I haven't been to work for about 10 days now. There's just no work, and we're waiting for notifications to return to work. We haven't received our salaries." He explained that he has been working hard to help his son pay off a mortgage. Now it's hard to find a place even if extra effort was spent. Mr. Xing, who works in the IT sector, shared that his relative works in a factory involved in foreign export. His relative's factory specializes in producing pots, a low-end industry focused on raw material export. According to Mr. Xin, the factory has indeed seen a decrease in orders, but is still maintaining operations, although not as profitably as before. He noted a general reluctance across various industries, including IT, to spend money as freely as in the past, suggesting a downturn in economic prosperity. China's economy continues to struggle, with major real estate companies like Evergrande and Country Garden facing financial crises. This situation has put the livelihoods of thousands of construction workers at risk due to delayed wage payments. Angered and disappointed, these workers have taken to the streets in protest, demanding their unpaid wages at the company headquarters and factories, only to face aggressive dispersal tactics. Recently, in front of Guangdong's Hailong Construction Technology, dozens of workers gathered to demand their wages but were met with water cannons by security personnel. Some men, unable to dodge in time, were drenched. Netizens expressed outrage, noting the inhumanity of spraying water in winter, where getting soaked can be extremely uncomfortable and cold even in the warmer south. In Shanghai, elderly workers, unpaid by Powerlong Commercial Management, have resorted to sleeping on the streets outside the company's office as a form of protest, continuing for over a month. The company has ignored them, failing to address the issue of unpaid wages. Police have used blue tarps to obscure the protesting workers from view. One striking image shows several elderly individuals kneeling at the entrance of Powerlong Commercial Management, holding up a sign that reads, "Powerlong Commercial Management, pay back our hard-earned money." It has been reported that in China, there is a significant number of older migrant workers engaged in daily wage labor. These workers often start their day before dawn, around 4 or 5 in the morning, in search of work. They spend long hours each day, leaving early and returning late, enduring strenuous labor for an entire month, only to earn just enough to meet their basic living needs. In a recent case, China Construction 4th Engineering Division Corp. Limited, located in the Huawei district in Liaoning, has been accused of owing wages to migrant workers. Facing this predicament, the workers, left with no other recourse, have been forced to endure the cold and resort to sleeping on the floors of the company corridors as a form of protest and to demand their unpaid wages. China Construction 4th Engineering Division Corp. Is a state-owned enterprise. In Zhangjiakou, Hebei Province, at the Phoenix City Phase 4 project, construction workers have been protesting for a month over unpaid wages. Videos show hundreds of workers gathered at the local government office. The workers appeared to be peacefully standing, with police threatening to use tear gas and forcefully dispersing them. A real estate agent in Zhangjiakou revealed that due to a significant drop in housing prices and poor sales, many developers are facing financial insolvency. This has led to several construction sites halting work, resulting in unfinished buildings and workers demanding unpaid wages. According to Voice of America, Li Qiang, founder and executive director of China Labor Watch based in New York, said that the overall economic downturn in China, especially in construction and service sectors, has made wage arrears for migrant workers a common and severe issue this year. Li stated, "The situation of owing wages to migrant workers in China this year exceeds that of the past few years, making the situation extremely serious. The prevalence of wage arrears is a consequence of the overall economic environment in China. The primary culprits are in the construction industries, but the owners in construction industries are reluctant to owe wages as they are often the victims of delayed payments from local governments, state-owned enterprises, and national development projects. When local governments are heavily indebted and unable to pay for the projects, the owners have no choice but to delay paying the workers." The serious issue of wage arrears in China is also contributing to social instability. Analysts say that owing wages to migrant workers has become a norm in China. There is a prevalence of dissatisfaction in Chinese society which has yet to find an outlet for expression. There is a significant group in China, the debtors, who could further contribute to social instability. If mass incidents occur, they are likely to participate actively. In response to potential large-scale protests, Chinese state-owned enterprises in cities like Shanghai, Wuhan, and Huizhou have established People's Armed Forces departments. According to Radio Free Asia, over 20 state enterprises has formed such departments in a few months, including the Shanghai Municipal Investment Group under the Shanghai Municipal State-Owned Assets Supervision and Administration Commission, directly managed by the People's Liberation Army Shanghai Garrison. Besides Shanghai Municipal Investment Group, other state-owned enterprises in Guangdong like the Huizhou Water Investment Group Company Limited, Transportation Investment Group, and Urban Construction Investment Group have also recently established People's Armed Forces departments. Chinese netizens question whether these People's Armed Forces departments in state enterprises are targeting citizens defending their rights. Some believe these measures are preemptive preparations for potential mass protests of economic downturn, suggesting that the authorities are bracing for imminent mass protests. Commentator Bi Xing suggests that the authorities hope to suppress potential large-scale rights protection events through these People's Armed Forces, calling it a new method of maintaining stability. Amidst weakening domestic and international demand, the negative sentiment among purchasing managers seems persistent. Official Chinese data shows that the Manufacturing Purchasing Managers Index, PMI, fell from 49.5% in October to 49.4% in November, below the economist's prediction of 49.7%. The threshold of 50% separates expansion from contraction, with figures above 50 indicating expansion and below 50 indicating contraction. Dan Wang, chief economist at Hang Seng Bank in China, expressed concerns regarding the domestic market's inability to compensate for losses in Europe and the United States. He noted a decline in factory output and employment, stating, "The data indicates a reduction in factory production and workforce." Wang further suggested that the data might also indicate a loss of confidence in government policies. He also warned that due to other prevailing economic issues, improvement in factory activities is unlikely to occur soon. He said, "The current priority clearly is to control the risks of debts brought by local governments and local banks." The sub-index for new orders contracted for the second consecutive month, while the new export orders sub-index continued its downward trajectory for the 9th consecutive month. Another concerning sign is the contraction in the vast service sector for the first time in 12 months. The non-manufacturing PMI, including services and construction industries, dropped to 50.2% in November from 50.6% last month. China's PMI has contracted in 7 of the past 8 months, only breaking the 50% threshold in September. The last time PMI continuously recorded negative values for more than 3 months was during the 6 months ending October 2019. Analysts have warned that China might face Japanese-style stagnation later this decade unless policymakers shift the economy toward domestic consumption and market allocation of resources. Moreover, according to the data released by China's General Administration of Customs on December 7th, exports in November amounted to 292 billion, a year-on-year increase of 0.5%, better than the 6.4% decrease in October and the highest in 5 months. This figure also exceeded the median prediction of a 1.1% decline from a Reuters survey of 28 economists. Imports in November were 223.5 billion, unexpectedly falling by 0.6% year-on-year, significantly below the median forecast of a 3.3% increase from the Reuters survey. In October, imports had grown 3% year-on-year, reaching 218.3 billion. However, some analysts suggest that to interpret customs import and export data accurately, one should consider the cumulative figures up to the current month minus the cumulative figures of the previous month. For example, the customs announced $291.4 billion in exports for November. However, the cumulative exports from January to November were $3.077 trillion, and from January to October were $2.79 trillion. Therefore, the correct calculation for November's actual export volume should be $3.077 trillion minus $2.79 trillion, which is $285 billion. Last November's export volume was $294.7 billion, indicating a 3.2% year-on-year decrease this November. Caixin, a Chinese financial news outlet, also reported that the year-over-year improvement in China's exports in November was due to a lower base in the same period of 2022 and a cyclical rebound in global technology, but the improvement was less than market expectations. Despite the improvement in exports in November, Reuters reported that there are no clear signs that pressures on Chinese manufacturers have fully eased in the short term. Reuters quoted Zichun Huang, a Chinese economist at Capital Economics, who said, "There is a new record in volume of total exports, but it's supported by exporters cutting prices." Huang warned, "We doubt this trend will continue as exporters cannot afford to keep cutting prices." Zhiwei Zhang, chief economist at Pinpoint Asset Management, told Reuters, "Although export demand has improved, it's unclear if exports can continue as a growth pillar into next year." Zhang also warned, the economies of Europe and the US are cooling. China still needs to rely on domestic demand as the main driver of growth in 2024. Analysts say that it's too early to determine whether China's recent support policy is sufficient to stimulate domestic demand and whether foreign demand can continue to rise. Challenges such as the ongoing crisis in the real estate sector, high unemployment rates, and weak confidence among households and businesses threaten the sustainability of a domestic growth rebound. The International Monetary Fund, IMF, in November revised China's growth forecast for 2023 and 2024 upwards by 0.4%, but this is based on a lower baseline. Simultaneously, Moody's Investor Service downgraded China's government credit rating outlook from stable to negative on December 5th. This action highlights the growing unease in the international business community about the impact of soaring local government debts and a deteriorating real estate market on China's economy. Moody's stated that the downgrade reflects the likelihood that Chinese authorities will be forced to increase financial support for heavily indebted local governments and state-owned enterprises, posing broad challenges to China's fiscal, economic, and institutional resilience. The trends in China's financial markets seem to mirror this cautious analysis. Following the publication of November's import and export data, the Chinese yuan's exchange rate against the US dollar showed a slowing momentum. Concurrently, the CSI 300 index, a widely tracked benchmark of blue-chip stocks in the Shanghai and Shenzhen stock exchanges, fell by 0.44%. Additionally, Hong Kong's Hang Seng Index, a major stock market index in Asia, experienced a more significant decline, dropping by 1.46%.